8 investing mistakes that will leave you broke. There's a lot of misinformation out there, and I'm here to dispel it. Some of these mistakes I've made myself, or I might know friends or family members that made some of these mistakes. Hopefully, you will learn from our mistakes. The first thing you have to pay attention to are the investing gurus. You always want to be careful with people talking to you and giving you advice on what type of stocks you need to invest in, because the biggest issue that I have with these investing gurus is that they will tell you when you should buy a specific stock, but they never tell you when to sell that stock when it's not doing well. Not everybody that's giving you investing advice has bad intentions, of course, because some people just like investing. They get hyped up when it comes to companies that they like. So they might like Tesla, they might like Google or Facebook. Out of their good nature, they might tell you, oh, go ahead and invest in Tesla because that's a company that they like. But you always have to pay attention to investing gurus that have a financial component to the advice that they give, because there are a lot of gurus that get a kickback if they promote a specific stock or company. So always do your research on who's actually giving you this advice. Is this coming from a person on the television? Is it coming from somebody on the internet? Always do a little bit of digging, a little bit of research to see, okay, are there any financial incentives tied to the advice that this person is actually giving you? The second mistake is investing without doing your research. So this goes hand in hand with the guru, because the guru will jump up and tell you what to invest in. You don't do your own research and you just jump and invest in a specific company. This is a quick way to invest in companies that might be worthless. Nowadays, it's extremely easy to do research on a company because all this information is available online. All you need is the company's name or even the ticker symbol. You can dig into Google, dig into your favorite search engine, and start reading what the company does, how much the company is generating in revenue, in sales, in net income, how much debt a company actually has. What you want to do is you want to look at a trend. You want to look at previous years of performance and see if the company has been able to grow its revenue, its sales, etc. Don't just buy something on a hunch. And even if you want to be on the safe side, you can always invest in an ETF or an index fund that tracks an underlying index. The third one is thinking that it's too late to start investing. Sometimes I talk to people that are older, so 50 and up, and they've never invested in the stock market. And they might tell me, okay, it's too late for me now to start investing. But the way I always look at it is that you won't be able to work your whole life. There will come a time where you're physically not possible to work. And in that case, you need to have the money that you've generated over all those years and decades. You need to have that money working for you. So even if you think that it's too late to start investing, you still need to dip your toe into the investing swimming pool, because it's not only about you, it's also about your next of kin, which might be your nephews, your nieces, your kids, even other family members. And even if you're scared to start investing, you can always start with investing a little bit of money. Nobody tells you that you need to start investing with thousands of dollars. No, you can start small. You don't even need to buy a whole share. You can buy a fraction of a share. So even if you have 50 bucks, 100 bucks, 20 bucks, start where you are. And when you do get more comfortable, that's when you can add more money to invest in different stocks, bonds, ETFs, mutual funds, etc. And also, when you invest with a little amount, it's a lot less stressful. And it's also going to be a lot more fun. You learn the basics, and before you know it, you'll be adding more money. And that brings me to the next one, being too afraid to invest in the stock market. Because people always hear about the horror stories. So they might know a friend or even a family member that put all of their money in a specific stock. That company ended up going bankrupt and they lost all their money. Now, the problem with this is that not investing in the stock market, that might be a big reason why you will go broke. Because the money that you have, yes, you might have it in a savings account or even a checking account, but the money that you have in those accounts will not grow faster than inflation. So when you invest in stocks or even bonds, at least your money is able to keep pace with inflation or grow faster than inflation. So your money retains its buying power. But if you get your money and you put it under your mattress or even you put it in a savings account, which gives you less than 1% in interest, your money is going to be worth less over time. So in this situation where your money is losing its buying power over time and you're more than likely not able to work in your elder years, that's going to leave you broke pretty fast. And then the next one is being too emotional when you invest. It's easy to get hyped up when you see the stock market in a bull market, which means on average the stock market is going up. And it's also fun to see your favorite stocks going up over time. But what happens when a stock crashes or a stock dips down? Are you going to be emotionally sound enough to still hold on to your stock? Or are you going to panic and sell your stocks? That's something that you will also learn if you start investing with a small amount of money. You will see the value of your investments go up and down. But since you started with a small amount, it's not going to hit you that hard. It's only when you have thousands of dollars and even hundreds of thousands of dollars invested in the stock market and you see the stock market dip or crash by 30% or more. Are you going to get emotional then and start selling like crazy? That's something that you do not want to do on a hunch. Even if everybody around you starts selling, you still want to take a step back, take a deep breath, and really think about what you're about to do. More than likely, the stock market or the stocks that you're investing in, especially if you're investing in a index fund or an ETF, more than likely it will bounce back. Now, it might take some time. It might take months or even years for it to bounce back. But at least you're not losing your money because the money is still invested in the stock market. So the loss that you're seeing is a unrealized loss. It only becomes a realized loss if you sell that particular security. Now, number 6 is falling for a pump and dump. This kind of goes back to the gurus we talk about. So you will have somebody that advertises or tells you that you should buy a specific stock or specific security. They might not only tell you, but they have a whole audience that they're advertising to buy that specific stock. Everybody ends up buying that stock, in essence, increasing the value and the price of the stock. And when the price is at its highest, that's when these unscrupulous gurus sell all their stocks in that specific company and they make a quick profit. Meanwhile, while they're selling, the stock price is going down and it's crashing, and you're pretty much ending up with a stock that is worth nothing. So you just got scammed by the pump and dump method. The funny thing is that my dad actually got scammed with a pump and dump method because this happened back in 2004, 2005. He got a phone call from a investment firm, an investment company that was pitching him a specific stock or a group of stocks to invest in. Now, I was not listening into that phone call because I was not with my dad. But what ended up happening was he invested in that specific security. And within a couple of months, the value of it tanked so much that it was worth nothing. And that experience turned him off from investing for a long time. It wasn't until I started investing and teaching him some of the things to look out for that he got back into investing. He never told me this story. He only told my brother this story. And if he told me this story when it happened, I might have also refrained from investing in the stock market. Luckily, I never went that route. And then number 7 is not diversifying. So it's easy to get excited about specific stocks and just put all your money in one specific stock. But that's the riskiest thing you can do because you don't want to put all your eggs in one basket. You do want to spread your money across a multitude of stocks, bonds, even securities. It allows you to lower your risk because if all your money is invested in one stock, let's say that company goes bankrupt, you pretty much lose all your money. But if your money is spread out over 10 different securities, even if one ends up crashing or you lose money in one, you still have a good chunk of money invested in the other 9 securities that you invested in. Diversifying also puts your mind at ease. It will also make you sleep well at night because you're not only focusing on one particular stock or investment since it's spread out over so many. A good way to diversify without even having to think about it is to buy an ETF or an index fund, anything that tracks the S&P 500. So the Vanguard company has a lot of good ETFs and index funds that you can invest in also. That will give you that instant diversification. And number 8 is timing the market. Now, there's nothing wrong with trying to time the market. And I know day traders and swing traders are experts at knowing when to buy and sell. Even they themselves take losses. If you're just a beginner who's investing or you're just a novice, timing the market will more than likely not work for you. It's better to just buy and hold, and over the long term, over the long run, you will see your investment grow. Most people that jump into the stock market think that you can get rich fast, but investing shouldn't be looked at like that. For every one story that you hear of somebody getting rich fast in the stock market, there's millions of others that actually ended up losing their shirt. So look at investing more of a slower process of building wealth and getting rich. Now, if you like this topic, make sure to leave a comment if any of these mistakes you've ever made. And of course, like this video, and I'll talk to you guys in the next one.